Hey guys, when you think about growth and growth ETFs, one name always comes up, and that is QQQ. And the reason that comes up is because people have been talking about the NASDAQ, or the NASDAQ 100, in all the news. In everything you see NASDAQ, 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 NASDAQ. And one name in particular that tracks the NASDAQ 100 is QQQ. So, is QQQ the best growth ETF on the market, or is it just one of the ones that everybody talks about? Now in today's video, we're going to be talking about 5 reasons why I think QQQ is one of the best growth ETFs on the market. And in the comments, just let me know if I'm right or am I wrong, or if you have a better growth ETF that I should talk about. Alright, hey guys, my name is Steve and I run the Frugal Expat, where we try to help people to save more and invest better. So make sure to hit that like button and subscribe, and I'll continue the great content to help you do better. Alright, let's get to it. Now let's first talk about a little bit about QQQ. So QQQ was started in 1999, and it tracks the NASDAQ 100, which is the top 100 companies on the NASDAQ index that are non-financials. So what the NASDAQ does is it ranks the top 100 companies that are non-financial and have a high market cap that do about a little bit over 200,000 trades per session, and it's been trading for at least 3 months. So this is a great index that can track a lot of the growth and great big companies that are coming up and are innovating in the market. Now you may think about these as you see there are Nvidia, Apple, Amazon, Microsoft, and even Costco is part of this NASDAQ 100. So when we look at this ETF, we want to see what makes it so special. Well, first of all, let's get down to some of the basics. QQQ holds about 102 different holdings. It has an expense ratio of 0.20%, which means it costs about $20 for every $10,000 invested. Now it's been around since 1999, so it's seen the ups and downs of the dot-com boom, the GFC, the COVID crash, and all the other crashes that could happen in the last 25 years. Now it is ranked the #1 large cap ETF by Lender, as in one of the top producing ETFs on the market. It's a #2 traded ETF on the market behind SPY, and it's got a 5-star Morningstar rating. So that means it's rated as one of the best ETFs that you could buy and hold. The dividend yield is about 0.56%. So if you're looking for dividends, this may not be the dividend ETF you're looking for. It's primarily looking at growth companies and trying to grow your portfolio. Now tech makes up about 52% of this portfolio, with the top 3 being Nvidia, Microsoft, and Apple making up about 25% of the portfolio. Now the top 10 does make up about 50% of the portfolio, so we have a little bit more concentration in those top 10 companies that are made up of max 7 companies. You got Microsoft, Amazon, Nvidia, Meta. You've got even Costco as part of that top 10. So these are top 10 companies that are working on innovation, working on growth, and it's got a great performance over the long term. I was looking at the last 20 years all the way up to 2005, and QQQ has grown about 15% on average since then. In the last 15 years, it's been 18.88%. In the last 3 years, it's been about 23%. So as we can see, this ETF has done an amazing job growing in performance. It has done an amazing job giving people the ability to have a piece of a large cap part of the US economy, and it's got lots and lots of great things that come about it. Now, I said I have 5 reasons that I think makes it one of the best growth ETFs out there. So let's get into those 5 reasons. #1 is the exposure to some of the most innovative companies in the world. Now, these companies are like tech giants, or even retail giants. I mean, we're talking about Apple, Microsoft, Amazon, Meta, and Tesla. And these companies are even like Costco as well. So when we look at these companies are innovating in AI. Nvidia is an AI company that is a chip company that's now become one of the top AI companies in the world. Microsoft and Apple create lots of different products like software and even products that they sell. Now, Microsoft evolutionized software, and now it's continued to create cloud content. It's creating gaming through Xbox, and it's creating so many different things and products. And then you have Amazon doing cloud computing. It's got a whole bunch of stores where people are delivering Amazon products, people are creating products, people are selling, and this has been revolutionized in our technology. So we have to think about, if we're wanting something that's going to kind of create something and make our life different, we got to think about QQQ. QQQ holds some of these best companies, and it's a great way to have a piece of this innovation and a piece piece of this economy that's creating tech, creating AI, creating cloud systems, and creating and revolutionizing just the way we do work. And so that's a great reason why you should hold QQQ. Reason number 2 is going to be the long-term performance. Now, QQQ has been around since 1999, and though it started off probably pretty good in 1999, 2001 hit and 2000 hit with the dot-com boom, and you know, things just kind of happen. But if you look at the long-term results of the performance, it has done pretty good compared to so many other different indexes. Like if you compared it to the S&P 500, QQQ wins. And if you compare it to maybe another growth ETF, well, QQQ wins again. And that is great news if you're looking for some performance. Now, performance may not be everything, and you may think that, you know, past performance does not mean future performance, and that is true. But if you look at QQQ, it has performed for a very long time. Now, I said I went back 20 years. That's because I wanted to do comparisons versus VGT and some other companies and ETFs. And if you go back 20 years, it has averaged about 15% every year. Now, that's amazing news. If you're looking for, I mean, if you think about the S&P 500, does it average about 10.3% over the last 100 years? And QQQ has done about 15%. That's huge when you're thinking about it. I mean, if inflation even takes away 3%, you're still making a good 12%. That's great news for your money and growing. Now, we're not even just looking at the 20 years. At 15 years, it's done 18.88%. At 10 years, it's done 18.13%. And at 3 years, it's done about 23%. Now, those are some amazing numbers. I mean, even with the ups and downs of the market, it has performed pretty well comparatively to a lot of different companies, a lot of different ETFs, and it is great when you're trying to grow your money. So why not add some shares to your portfolio and continue to grow, right? Right? Yeah, the performance may not be the past, but we have seen it in the last 3 years, 5 years, 10 years, and 20 years of performance that has doubled and created great wealth with a lot of different people. So that is a reason why it is a great growth ETF. Now, number 3 reason that QQQ could be one of the best growth ETFs is because it's diversified. Now, what that means is it's not just tech heavy with just tech companies. You have companies like PepsiCo, Starbucks, and Costco. Costco is actually in the top 10 of those holdings, and it holds about 2.7% of the holdings in QQQ. Now, that's amazing. And like I said, there's PepsiCo and Starbucks, and also Marriott is also in it, a hotel chain. So this is not just a tech-heavy ETF. It's got consumer staples, it's got healthcare, and it's also got communication services. So it's got a whole bunch of different sectors in this ETF, and only 52% go to tech. And that's amazing when you're thinking about trying to have a high-performance ETF, one that's not just tech-heavy, but also diversified, and one that's got great performance. Well, this ETF does it all, and it's quite diversified. One thing that makes it also, it's got some great criteria to make it where it doesn't get like super top heavy. So if you look at ETF like VGT's got Nvidia, Apple, and Microsoft that make up almost 47% of the ETF. With QQQ, you only have those top 3 making up about 26% of the ETF. Now, VGT would be great if you just wanted those 3 companies, but QQQ gives it a little bit more diversification. So what it does, it has a market cap weighting where no company can have more than 24% of the market cap. It also allows any company that makes up over 4.5% cannot equal up to 48% of the total holdings within this ETF. So if you have a couple different top heavy holdings, it cannot get to a point where those top heavy holdings that are over that 4.5% cannot equal up to 48%. So what it does, it rebalances every single quarter. So it will rebalance in March, it will rebalance in June, it will rebalance in September and December, so that this ETF doesn't get too out of balance, and it allows it to continue to have very diversified portfolio full of great companies that are not only tech heavy, but are created equal and have a balanced approach to it. So that is one of the reasons that I like it. It is diversified and not super tech heavy. So it's got companies like Costco. And the reason I say Costco is because I love Costco. I love going to it. And if you look at the performance of Costco versus a lot of the companies, Costco in the last 10 to 15 years has been on par with Apple. Like the last 15 years, it has averaged 23.75%, while Apple has been doing about 24 to 25% in that same time period. So Costco is not a growth company, but it's a great company that is growing and is bringing about great earnings. So that's why I like QQQ. I mean, if you look at a company like SEHG does not have Costco in that that top 5, but QQQ does. So that's something to think about. Now, number 4 reason is it's going to be the liquidity and the popularity with option trading. Now, you may not be into options, and that's okay. Not everybody is into options, but if you look at QQQ compared to some of the other ETFs, it is being traded very, very often, and it's the second most traded ETF on the market. SPY is the number 1 traded ETF on the market. When we're looking at option trading, QQQ becomes one of the best for covered calls, and it becomes great when we're trying to trade and make money off of these trades. Now, not everybody should be in the trading market, and that's okay. But if you like to be traders, I mean, SPY is a great one, but it tracks the S&P 500. But QQQ is another great one. This is the number 2 traded. So when we're trying to make trades, I mean, a lot of liquidity, a lot of trades means there's availability to make some money off of premiums, and that is good news for traders. And that's good news for those that are holding QQQ and they want to get into that trading aspect of markets and portfolio management. And so that's good news for those that are looking for trades. All right, let's get on to number 5. Number 5 is going to be manageable fees. Now, QQQ does have an expense ratio of 0.20%, which is about $20 for every $10,000 invested. Now, this could be one of the more expensive ones compared to other growth ETFs. schg and VUG both have an expense ratio of 0.04%, which means they are a cheaper option to buy and hold than QQQ. Now, if you wanted a cheaper version of QQQ, you could always get QQQM. Now, QQQM has an expense ratio of 0.15%, which is much cheaper than QQQ. And this is a reason that you may want to buy QQQ or QQQM, is because the fees are pretty low if you're comparing it to actively managed funds. If you compare it to other growth ETFs like IYW is one of those great growth ETFs that are more expensive than QQQ. Its expense ratio is sitting at 0.39%, and that's a little bit more expensive than QQQ, which is at 0.20%. So fees matter, and having low costs matter. So should you have QQQ or QQQM? Well, it's a thing about, do you want to pay less fees or do you want to have a cheaper ETF like schg? Now, today we talked about 5 reasons why I think QQQ is one of the best growth ETFs out there. Now, it's got a great diversification. It's got a great performance. It's got a pretty good expense ratio, even though there are cheaper ones. And it's got high rankings from many of the top places, and it's good for traders if people want to trade options. So what are some cons to this ETF? Well, of course, there are definitely cons, and the cons could be that maybe the share price is too high. I mean, the share price is sitting at like $400 to $500, and it's hard to get in unless you get in fractional shares. So you can get good fractional shares from Fidelity or from M1 Finance, but if you have a Vanguard account, you have to buy the whole share. So it's cheaper, probably go with QQQM or even a cheaper growth ETF like schg or VUG. Now, one other thing is maybe the expense ratio is too high. And like I've already explained before, there are other growth ETFs that have cheaper expense ratios. Maybe you wanted more companies within it. So QQQ has about 102 different holdings, while schg's got about 228 and VUG's got about 280 different companies. So the diversification is not there compared to other growth ETFs. So would those other growth ETFs change your mind? Possibly. Could be. I mean, I have talked about schg a lot on the channel because I like it, and it's a great one that you can buy and hold for long term. It's got a great share price, great expense ratio, and pretty good diversification. But what about QQQ? Should you be thinking about QQQ? I mean, I think about it often. I actually hold QQQM in my portfolio. QQQM is doing great, but that's me. What about you? Are you investing in QQQ? Are you investing in another growth ETF? Let me know in the comments. What is your favorite growth ETF that you are investing with today? And let me know if you have any other reasons why QQQ could be the best growth ETF on the market. I'll see you guys later in our next video. You guys take care.